Our next area is competitive advantage. And competitive advantage is really, what is it that gives me an advantage over the other organization? Some of us would have heard about Southwest Airlines or JetBlue. And the question is, what's the competitive advantage that Southwest Airlines has over, say, American Airlines or Delta or any of those other airlines? The bottom line really is that they have a cost advantage in that Southwest pursues a low-cost strategy, and therefore it is able to make a higher level of profit than the competition, namely at this point in time, American Airlines. Now, as far as Disney is concerned, Disney's competitive advantage would be to pulling in larger crowds than any other entertainment center, to give them a wider variety of treats, and to be able to have the customer satisfied while charging a price that makes the organization more profitable than the others that are around. And so it's important then that the organization has the level of competitive advantage that allows it to be able to generate the level of profit that is greater than the competition. Now let's look at the differences in time in terms of what is it that we would expect from an organization that has strong competitive advantage and one that is just really struggling. The one that has strong competitive advantage must be able to do something or offer something to the market that the other organizations do not have. Secondly, the organization must be creating more value than the competition. Now, what do we mean by creating more value? Value there is value to the customer, value to the shareholder, value to the general public. Value to the customer means that I am satisfied that when I pay $50 to enter a Disney ride, I feel satisfied, I'm happy, I get value for money. What is value to the shareholder? Return on investment one, so I'm getting a dividend. But most importantly, we may recall that at the beginning we said that the share had not moved by more than 6%. Now, if and because of that, that is why Eisner was hired, because the board was dissatisfied. Now, how do you create value for the shareholders then? You have to show the shareholders that you're moving from 6 cents to 12 cents, 15 cents, 20 cents. So that is value to the investor or the shareholder. Now, what about the general public? The government, and when we speak of the general public now, the general public wants to know that you're not a nuisance, there's good corporate or social responsibility as far as the organization is concerned, and you're paying your taxes and you are meeting your obligations accordingly. So that is really what gives the one company a competitive advantage over the other. Namely, value to the customer, value to the shareholder, and value to the general public. Looking at the whole matter of economic models, we have perfect and imperfect competition. Perfect competition is that in Jamaica we say a lot that we do not have perfect competition in terms of the Jamaica Public Service Company because they are a monopoly. But we have perfect competition in the supermarket business in the sense that we have the high-low, we have Super Plus, we have Empire. So if I don't want to buy from High-Low, or if High-Low's price for mackerel is higher than Empire, I move across. So there's a level of competition, perfect competition. So in a monopolistic situation like JPS, what has to happen is that the government, through the OUR, has to now regulate accordingly. So that in looking at the economic models, then we have to recognize that the graphs as shows that the assumption is that even that every firm is the same. It's assumed that profits are normal, that average total cost is equivalent to average price, as the case may be. Now, in looking at other areas, if we look at the cellular telephone areas, provides a quickly matching the offerings of the competition, and you see Claro and Digicel and all of those offering you free nights or free calls, etc., etc. So that the whole business of perfect competition is assumed. But then, as a business, we cannot always speak of perfect competition. What we have to do is to make sure that our organization is competitive. Now let's look at competitive advantage again as to whether it's sustainable or not sustainable. Competitive advantage is not forever. You have competitive advantage today, but over time it may not be. Now, what is going to give you a long-term sustainable competitive advantage? What will give you that is the basis on which you are managing your business appropriately. You are delivering your goods at the right price, the right quality. You have the necessary skills and competencies. You are generating value for your shareholders, for the customer, and for the general public. Unless you do that, there's always someone that is coming against you. So let's look at IBM. IBM was the computer giant many, many years ago. And then came this guy called Apple. Because in the days of, and we're talking now, most of us weren't born in those days. But, well, I shouldn't say most of us. Some of us weren't born in those days. But in the 1980s, IBM was the computer giant. Now what happens? These guys built computers that Horace Williams would have to be a computer programmer to manage it. And came this guy with Apple, said, no, a computer should be used by everybody. And IBM had competitive advantage for years. And when Apple came with its Macintosh, the whole computer business changed. If you look at Apple today and look at Microsoft and look at those guys, you find that what they recognize, so Apple comes up with the iPod and the iPad and all of these fancy phones. You cannot sit on your laurels because you have to make the change. So that is the whole business of whether competitive advantage is sustainable or not sustainable. Now, when we look at the whole business of competitive parity, we are looking at the extent to which the organization offers make the same offerings. Does Microsoft offer the same thing as Oracle? Does Grace offer the same thing as Lascelles? Does our Bride or Musson or whatever? No, is it equal? May not necessarily be so, but we have to now look at exactly what it is. Now, there are some measures that we can use to measure competitive advantage, and that comes back to our return on investment, what we call the accounting measures: return on investments, return on assets, the whole business of share, earnings per share, etc. And so we can say that the extent to which my operations are more competitive than yours is not only looking at it from the outside, but also looking at the offerings that are made by the different organizations. Looking at it globally then, and looking at where we are in terms of strategic management, we would have covered what strategic management is about, the process of developing your strategy, the importance of competitive advantage, the extent to which you can sustain competitive advantage, and the importance of strategic management. And it basically is, we want to know where we are as an organization, where do we want to go, and how do we get there. And there's a famous saying that if we do not know where we're going, any road will take us there. And so that is really how we look at strategic management, and how we chart a course of action to make my organization much more competitive. So when looking back in Disney then, is that what is expected from Eisner is to take this organization, Disney, out of the lull and make it the dynamic force that Walt and his brother Roy foresaw when they formed this great company.